Hello class and welcome to our fourth lecture series on principles of accounting or financial accounting, and I'm your instructor Dr. Jamel. Okay, so in our previous class we were talking about the transaction analysis through balance sheet equation. And what is the balance sheet equation? Assets is equal to liabilities plus owner's equity. So we talked about asset records, transaction records, two sides, given and taken, receipt side or given side. So now let's talk about the next learning objective, which is analyze the impact of business transactions on accounts. Previously, we talked about analysis of transaction on bigger scale assets, right? And now we are segregating what effect it has on its accounts like cash, inventory, account receivable. We talked about that. These are the accounts like long-term asset, plant, asset, building, right? Here we go. So now we discuss the accounting principles, the law of accounting. Up till now we have discussed the accounting equation, and now how the transaction going to affect the accounts. So the system in which right now we are talking about, the system in which one side is recorded as given, other side is recorded as receipt. We call that system as double entry system. Double entry system. So each transaction affects at least two accounts. If cash is taken out from the business, it must be for some purpose. It must be affecting two accounts, cash and some other accounts. If a transaction is only hitting one account, then it may not be considered under double entry system. So what is double entry system? At least a transaction affect two accounts, right? Here we go. In order to understand the double entry system, so we make the account as T account. So a T account is like this T, right? The right hand side is called credit, the left hand side is called debit. So we show credit from credit side, right hand side. This is not the credit on account, okay? This is not that we will pay you later. No, this is for example, this is account title, for example, account receivable. So right hand side is called credit, we denote it by CR. Left hand side is called debit, we denote it with DR, right? Understand? Guys, are you with me?
Yes.
Yes.
Good. So please, time to time, participate that whether, I should know that whether I'm talking to myself or I'm talking to you, okay? So time to time, you tell me that whether you are here or not. Okay, so a T account, it records the increase and decrease in the specific balance sheet account. Balance sheet accounts, asset account, liabilities account, equity accounts, revenue account, expense accounts. So in accounting equation, how this is different between, how this is different from accounting equation and double entry system. Here we go. In accounting equation, we record every transaction under accounting equation. We also record revenue under retained earnings. We don't have separate account for revenue and expense. right? We record under revenue. We record under retained earning, and retained earning is written under owner's equity. But in double entry system, we have a separate account like T account revenue. So right hand side is called credit, left hand side is called debit, which have a same separate account for expense. Right hand side is called credit, left hand side is called debit. So the account, the T account increase, it records any increase or decrease in the account for asset, liability, equity, revenue, or expense. So there are 5 categories of accounts: revenue accounts, expense account, asset accounts, liabilities account, owner equity accounts, right? So we understand that right hand side is called credit, left hand side is called debit. So in real life, these are the registers. Books where we record the transaction. For example, owner invested 100,000 in business. Which 2 accounts this transaction gonna affect? Number 1, business, cash is coming in, so cash account. Number 2, it's gonna hit capital, right? Or if this is a public company, then it is common stock. Business gave stocks, common stock equivalent to 100,000. Okay. So in this case, cash is like a cash register. Like we have a book, here. On here, this is written like cash. So there is a cash. Cash will be written on the cash book, but in accounting, we denote it as T account. Right hand side is called credit, left hand side is called debit. Similarly, there is a capital account book or common stock book. You will write it down here in business as T account for common stock. So every account has its own books, on registers. So what are the assets account? We talked about that. Asset is major account in order. Its accounts are current assets are cash and equivalents, inventory, account receivable, we talked about that, prepaid, and then plant, equipment, right? Building, land, right? So on each and every sub account, accounts to record assets have their separate register. Inventory would be written like this: T account for account receivable, credit, debit for inventory, cash and cash equivalent, credit, debit, right? So like each and every account has its own books to record transaction, right? And when you want to make balance sheet, you find out what is the end balance here from this book, cash book, you write it down on balance sheet, simple, right? So this is the idea behind that. So how to represent a complete register, a complete record? We represent it through T account here. Understand, everyone? Oliver, Noon, Benicia, Havarun, Spike,
Yes.
Marco, Tara, Nivia, Priscillo, David, Joao Paulo.
Yes, sir.
Okay, good. If you don't understand, please you can stop me over there, because this is very important, because all of the future lectures depend upon understanding of debit and credit. So I want I want to make sure that you really understand what do we mean by debit and credit. So debit means left side, credit means right side. So that doesn't mean, so many students they confuse debit with plus sign, credit with minus sign. No, my dear, no. In accounting, these are called sides, not the plus and minus. Remember this one. Most of the students, they make a mistake. They consider debit mean plus, credit mean minus. No. This is which side you need to record, right? So you need to understand that these are not plus and minus. So there are some rules for debit and credit. So increase and decrease in account, the rules of debit and credit. So remember, if any of the asset account increases, for example, we purchase plant or we purchase building. So building increase, right? If increase, we write it side on debit side. If we sell our building, building decreases, we write it down on credit side, right? And look at that on the other hand side. On the other side, right hand side of the equation, if liability increases, right, we purchase supplies on account, accounts payable increase, so we write it down on credit. So that logic, which students say that okay, debit means plus. So you see debit here is plus, but plus mean on the liability side credit. So that's why I'm not gonna ask you to go through shortcuts and all this stuff. No, understand the logic behind that, because this is the right hand side of the equation, this is the left hand side of the equation. On left hand side, any increase in asset would be recorded on the debit side. On the right hand side of the equation, liabilities and owner's equity, anything that increases liabilities and owner's equity, we write it down on credit side. Right? This is how we record the transaction. Understand, everyone?
Yes.
Yeah.
Asset, you can write it down asset. If asset increases, which means plus, we write it down on debit side. The amount we will write it down on the left hand side. If asset decreases, which is minus, we record it on the right hand side. Similarly, liabilities, if liability increases, we record it down, we record here on credit side. If liability decreases, we record it on left hand side. Similarly, with the owner's equity, if increases, we record on the right hand side. If decreases, we record it on the left hand side. So let's talk about this application. How we are going to actually record the transaction here in T accounts. So we already know the Freddie Auto Service Incorporation, because we are continuing this example from our lecture 2-3. Here we go. So Freddie Auto Service Incorporation, this is a business. It received 50,000 and issued stock. So received and gave. So at least our transaction gonna affect two accounts. Which accounts?